protecting capital is very important. When you're producing income streams from your investment, you don't want to deteriorate that capital because it's going to be harder and harder to produce that same level of income.
Hi, I'm here with Rob Lauzon, our Chief Investment Officer and Lead Portfolio Manager on Income Plus. Rob joined us a long time ago, feels like, 2002, a few years after I joined, and has really been managing Income Plus since he joined Middlefield. And as you may know, Income Plus has generated excellent both short and long-term returns. And Rob's really stayed focused on income investing, and as our CIO, he's been instrumental in developing our investing methodology and guidelines that really permeates all of our strategies at Middlefield. So with that, welcome, Rob.
Yeah, good to be here, Dean.
And maybe tell us about Income Plus, how long you've been managing it, what your strategies are, and maybe distinguish it from our other leading diversified income fund, Global Dividend Growers.
Yeah, sure. So Income Plus has been around for over 2 decades. As you said, a good long-term track record. It's a low-cost North American equity income fund. So, it's first and foremost, I come in every day looking to generate income with primarily equity holdings because it pays an annual yield to fund holders. It's diversified amongst sectors. I don't take any large sector bets. I'm an active manager, so we are overweight, underweight sectors, but no massive sector bets. And then on the micro level at the firm, typically you'll see us with weights of 2 to 5% in names. We've got some rules that allow us to gravitate a bit above 5, but that's usually on capital appreciation. And if you see a name at 1% in our fund, typically it's on its way out or on its way into the fund. So very high conviction, not high concentration portfolios. So the 25 to 40 names that you'll see in our portfolios and Income Plus in particular, there's a story and there's a reason I own each one of them and have high conviction on it. Global Dividend Growers is another diversified fund that we have. As the name states, a little more exposure globally than Income Plus, which is primarily North American. So you'll have a few Japanese or a few European names in that fund. But by the name of it as well, and one thing that complements with both of these funds, I look at dividend growers. So we love dividend payers, but also are focused on companies that can grow their dividends each year. And, that's really a function because they're growing their earnings and cash flow. So good businesses have the ability to grow their dividends. So they're a little bit different in the sense that Global Dividend Growers has a lower hurdle rate on its dividend it needs to achieve each year. So it allows the manager, Shane Obata, that runs that fund to have a little more growth bent in his portfolio, where Income Plus is income first. I want to try to generate that 5% I pay out to unit holders every year. And I do need growth, but it's a second priority for the fund.
It's an interesting juxtaposition. And as you say, Rob, I think they're complementary. A couple things. One, on Income Plus, the fund has shown a really good ability to actually perform better during periods of market drawdowns. So maybe you can describe, why that's the case. And then maybe get into as well your focus on companies that actually pay dividends or grow dividends, and how does that how would you characterize the portfolio today in light of dividend stocks versus non-dividend stocks?
Sure. So it has shown the ability for lower volatility than the general market. It doesn't capture the full drawdown often in bad periods in the stock market. And that's because I have the ability as an active manager to be aggressive and pivot to fixed income if I feel I'm still generating the income for the fund. But if I feel we're going into a deep recession, or if there's a world crisis that can't be fixed with, the Fed doing some interventions, and then, 3 weeks later, the markets are back on track. That happens all the time. Great financial crisis, COVID, scenarios like that we have the ability to be nimble and, shift asset allocation away from equities into fixed income. So I've done that from time to time. It's not the crux of the strategy of the fund, but it has helped protect on the downside, because protecting capital is very important. When you're producing income streams from your investment, you don't want to deteriorate that capital, because it's going to be harder and harder to produce that same level of income. And dividend growers and dividend payers, right now 100% of the names in Income Plus are dividend payers. And primarily most of them grow their dividend every year. I would say 80% of them grow their dividend. In fact, we just did a quick analysis. The last 3 years, the CAGR dividend growth rate for 3 years of the portfolio is about just over 8%. So the names are bumping their dividend 8% on average a year, and that's very healthy for the net asset value of the fund.
So it's an interesting point, because I think we're at an inflection in the market where there's been lots of cash sitting on the sidelines, and that's been accumulating over time in term deposits and GICs, and in Canada, HISAs, which are high interest savings accounts, getting 5.5%, in some cases 6% at the peak of this spike in interest rates. We've now got 3 rate cuts by the Bank of Canada. You've got the FOMC about to start cutting next week. So clearly we're on the other side of that. And there's been lots written about capital and cash that's been on the sidelines coming back into equity income. What are your thoughts on that? Have you started to see it yet? And then how does that affect how you're positioning Income Plus looking at latter part of this year and into 25?
Yeah, I think we're very much still restrictive from policy across the world. So we're just starting the policy easing cycle. So it's going to be a major playbook in 2025, where you might see, another 4 cuts out of Canada, 4 cuts out of the United States. So when we're in the depths of that cutting cycle, you're going to see cashable GICs and term deposits get back to, 2.5%, 3.5%, 3%. And investors that need income and are demanding 5-6% income streams, and to do that conservatively, you can't do it with fixed income anymore. And that's on the come, and it's just starting to happen. But where you can do it with proven companies that have grown their dividends for decades and continue to pay out their dividend without dividend cuts, and those are the names that populate our fund. So we're quite excited that the light is shining back on dividend equities, and the fund flows coming back into that sector. Our sectors should propel valuations to their averages, and many sectors, whether it's banks, whether it's REITs, are still trading below average multiples. And just the fund flows that will be continuing to come in, because we've started to see them in the last 3 weeks starting to turn, and some strategists have started to try to gather that data, and I think we're going to see more of that data show us that it's occurring now, it's starting now, and that's a good thing for price return on the stocks. And in the meantime, some of that money might want to go to bonds, but bonds don't raise their coupons every year. So we think a good majority of that money will come back to where it probably started from. It probably was in equities 2-3 years ago, went to cashables, cash-like products, and is going to come back into those sectors that I just mentioned.
And I'm assuming your view would be positive on real estate, because you've got a healthy exposure to real estate and Income Plus, and that's been additive to returns over the last 4 to 6 weeks, as some of these cash-like alternatives are finding their way back into stocks.
Yeah, we're double the index weight or the benchmark weight in real estate in Income Plus, and we run a lot of our funds as teams, right? We've got a formal portfolio management meeting every Tuesday at the shop. So my healthcare portfolio manager, technology portfolio manager, Dean's our real estate portfolio manager, and just best ideas come into a fund like Income Plus. So we're double the weight of the benchmark because of some of your ideas and your emphasis on your conviction on the sector all year, and now we're seeing the fruits of it. So maybe I'll ask you, Dean, where do you see your real estate now that we're starting to see the green shoots come back? How much more upside do you see as we go into 2025 on all of the subsectors in real estate?
Well, early this year, I adopted Blackstone's kind of view on the market, which was don't wait for the all clear. So they bought a portfolio in the U.S. in the residential. They also bought one in Canada. And their view was that valuations were troughing. They wanted to take advantage of that, even though you hadn't started this interest rate reduction cycle yet. So that's kicked in 6 months later. So we've now had 3 cuts in Canada, as we say, one starting in the U.S. next week. So market is finally starting to anticipate that. We've seen REITs in Canada up some 15% over the past 2 months. And we're still well below 2 to 3 turns on funds from operation, below where they have been historically. So I see lots of runway there. And I think another fact that has gone unnoticed by the market, or they haven't started to acknowledge it yet, is that the REITs publish regular NAVs, and those NAVs are a function of 2 things. One, you've got your income on the numerator and your interest rate or capitalization rate on the denominator. What's happened over the last 3 or 4 years as interest rates have gone up? Well, their denominator's gone up. That puts downward pressure on NAVs. But at the same time, income has been going up. So I've been saying for a while, the fundamentals are great. Income's going up. The thing they can't control is interest rates. Unfortunately, that's gone up. So we know now that's coming down. So what I'm expecting over the next 6 months as the NAVs that is, accepted by the market as consensus and published by the REITs are going to start finally going higher again. So I think, again, you've got lots of runway here. You want to focus on quality. The areas that we think are really well positioned continue to be industrial REITs. Yes, rental rates are plateauing. I think they're going to start accelerating again in 25 because all the new supply that's come on in industrial is now being absorbed, and very little new supply began a couple of years ago. So in 25, we're going to get very little new supply being completed. Multifamily, again, we've got a shortage of housing in this country, so rents are going higher. Retail, they'll tell you every retailer in Canada, major retailers looking for more space. Seniors housing, again, we haven't seen any really new development of retirement homes. Just now we're starting to see long-term care homes. There's too much demand, very little supply. Basically, every management team, and I met with about 20 of them last week at a conference here in Toronto, are telling me that the fundamentals in their business are good. And you've now finally got this tailwind we've been waiting for in this reduction of interest rates. So I think you're really good timing on seeing REITs, generate some solid performance.
Yeah, well, we'll keep the overweight in Income Plus. Thanks for that, Dean.
Yeah. Thank you very much. And Rob, keep up the great work on Income Plus, and we're looking forward to some, really competitive performance as we look forward here and rates start to come down and we see this soft landing that we've been calling for.
Great. Thanks, Dean.